Righto, money miners. Mate, we talk about anyone that's interested in coal. Holy shit, you are in the right place today.
I've got the coal with me.
Oh!
Special for the episode. This is from Hags, who kindly left it here. So I've just bring it out for the occasion, a momentous occasion, Matty.
Mate, it is. If you've got to go treat yourself to a colonoscopy if you're into it that much. So, mate, we've got a couple of sensational guests coming on. There's no better person to discuss anything coal than the global coal guru himself, who we've got on the show. And sorry, Koala, it's not you. No offence. Matt Warder, welcome back, mate.
Oh, buddy, thanks for having me. This is a momentous occasion for the coal industry. It's got me super excited, and we're having this on the day before Thanksgiving in the U.S., which is popularly known as Blackout Wednesday. So you're going to get really quality entertainment from our marsupial friend and I think here over the next over the ensuing 45 minutes. It's going to be fun.
Oh, I love it. I love it. Right. And Koala will be joining as well. While we're waiting on him, before we go deep on the Anglo-Peabody coal deal, bit of news out yesterday from the WA government, a bit of lithium relief. It's not relief, lithium waivers, you'd say. A bit different to royalty relief. We'll get into it.
What do you make of it, Matty?
Well, they're doing something. It's not a bloody game changer, first up, but it is a bit different to the precedent, the previous royalty relief we've seen. So Mr. Roger Cook unveiled this $150 million package yesterday, available to all lithium miners upstream and downstream across the state. So there's a couple of aspects to it. There's about $90 million that's getting allocated to the downstream, and that's pretty much they're waiving for 2 years government fees for like Development WA, Synergy, and Water Corporation. So water, power, and land fees. Yeah. So they're waiving that for 2 years. So it's not relief where they have to pay it back. It's actually getting waived for 2 years. So that'll be, these aren't just for the Australian listed companies. It's at the project level. So it's like, that's for Kemerton and for Kwinana. So it's like Albemarle and Tianqi effectively get benefit from it too, as well as IGO. Then you've also got lithium miners in the ramp-up phase of their project. You have the port charges and the mining tenement fees waived for up to 24 months, value of $9.37 million, very specific. So that would apply to Kathleen Valley, but also Mount Holland as well. They're the ones you'd class in ramp-up. Then there's also a combined $50 million loan facility that will be available to help lithium miners access temporary interest-free loans to help sustain on operations. But they've got to demonstrate their current financial position and operational plan. So they've obviously got to have a plan and demonstrate that they're, I assume, losing money. Don't know if it applies to break even. So they'll have to repay these after. So there's a 2-year interest-free period, then quarterly payments kick in after that, or if the lithium price goes over $1,100 a ton for spod US for 2 successive quarters before that, I think then the repayments kick in. So Gotcha. It'll definitely kick in after 2 years. So I assume that's at the project level as well. So I assume it wouldn't be I assume Greenbushes wouldn't get it because they're probably making money, but IGO will get the benefit for the downstream.
Yep.
Pilbara Minerals, I'm not sure if they would.
What's the need?
Qualify because obviously they've got a lot of cash. Are they break even, making a little bit? Probably wouldn't apply. So you're thinking definitely Liontown, all the MinRes asset, well, Mount Marion and Wodgina now because Balldill's shut. So and that's it. And I think that's at the project level as well. So it'd be like for MinRes, Albemarle, Gangfen. I'm not sure how that works if it specifically goes to MinRes. Mount Holland, even if you're Wesfarmers, you're massive, you'd still take an interest-free loan and chuck it on your balance sheet. Why wouldn't you? So it'd be like 15, 16 million split between those three. I don't know if it's all very definitive yet.
Stocks didn't really do anything, did they? It was a bit of a nothing burger on the share price front because, it's a policy that maybe gives some sort of relief, but it doesn't really move the dial.
Nah. Yeah. And look, for Liontown's case, say if they get 15, 16, 17 million or whatever, it's just something they can throw on their balance sheet they don't have to pay interest on that portion because it's interest free. So it's but it is, at least at least it's being waived. It's not something being kicked down the road that they have to pay back later. Obviously, the government's doing something to help. Just means there might be a slight more chance that people stay in work and people keep paying taxes. So that tax bloody offsets that tax. I think it's good. It's not like they're gonna, and it's not a special treatment for the lithium industry for perpetuity. It's like it is for 2 years. I think they've recognised there's been a zero chopped off the end of the spodumene price, so it's pretty unprecedented times for it, and it happened pretty quickly. So hopefully within 2 years' time, it's at $1,100 a tonne, and these operations that we've spoken about here can produce free cash flow sustainably and not be under the pressure they're in. So that's my take on it anyway.
I hope you're right, and I hope it doesn't. I hope the operations can stand on their own feet without relying perpetual government handouts to stay afloat.
Yeah, and it's not, and it's clearly not.
Yeah.
And I think this would be the last thing the government would do before. It's not going to. Yeah, it's not going to. I wouldn't imagine this would be the difference between shutting down and not shutting down. Put it that way. If they were going to shut down, you still have to shut down. This doesn't save operations, but it is a little bit of help.
Love it. Should we talk about a commodity that actually makes money and actually contributes a lot to the government coffers? Coal.
Now, before we get into it, this bloody Peabody coal deal with Anglo, mate, Peabody, if you're listening, you better have bloody called Adam Batista from CRE Insurance yesterday. He better have been on the line. The coal insurance expert, Adam, part of CRE, he needs to be on this. Don't put a transformational deal at risk without having the proper bloody insurance advice.
It sounded
from
like
the coal guru.
On the Peabody coal, it sounded like they were still, figuring out some things like CapEx and all that sort of jazz. Well, as you're figuring stuff out, Peabody, not that you had long enough in the data room already, as you're figuring stuff out, make sure you call Adam Batista. Look at him. He's wearing a coal hat right here. What a legend.
Adam should have been in the data room with you. Take Adam and CRE into the data room with you. Any mining company out there for a future deal.
Wicked. Well, we've got the wonderful Matt Warder and Koala from the eucalyptus tree with us today to talk about the sale process that's kind of captured everyone's attention over the last, God knows, like it's been 5 months that this has been in the airtime. And it's, of course, Anglo-Americans' sale of the Queensland coal met assets. This sale process sort of had it all. Matty, JD, Koala and Matt, there's just in the lead up, right? Like it all kicked off when in the aftermath of Anglo's gold alone strategy, when they fended off BHP, the sort of quick single they had was to sell the quality Queensland coal portfolio. And like back when they first announced it, the media was sort of reporting numbers that it would be worth up to $6 billion. And then gas ignited in the tailgate of the underground longwall at Grosvenor. The fire burned for nearly the whole month of July before being extinguished, and plenty of people started raising concerns that reopening would ever be even feasible. Suddenly, the press started calling it a US $3 billion portfolio instead of a US $6 billion portfolio. And here we are today. In the last week and a bit, Anglo's announced the outcome of the sales process. The first bit of the portfolio to go was their 33% interest in the Jallinbar group that owned 70% interest in Jallinbar East and the Lake Vermont mines. That went to Sam Chong's Zashvin for US $1.1 billion, who had a preemptive right. The other small asset to go by the sideways was Anglo's 51% interest in the Dawson complex, which has been sold to Boomer for US $455 million. And that left the rest of Anglo's portfolio, 88% of Moranbah North, 88% of Grosvenor, 70% of Aquila, and 70% of Cap Coal. The winner ended up being the St. Louis-based Peabody, who ended up bidding about US $2.3 billion cash, of which US $1.7 billion was upfront and $625 million spread over 4 years, plus a price-linked upside payments of up to an extra US $550 million over 5 years, plus contingent payments of up to US $450 million linked to Grosvenor's restart of production. All up, that was somewhere between US 2.3 and US 3.3 billion that Peabody's paying, depending on those contingent payments. And for Anglo, they find themselves scoring between US 3.8 billion and US 4.9 billion for the entire portfolio. Koala, Matt Warder, what did you guys make of the outcome?
Well, I mean, did you include the contingent payments on the restart of the Grosvenor mine?
Mm-hmm.
That's in there?
Yeah, 450 there, right?
Yeah. So that turns Grosvenor's restart project from if it were something similar to what Peabody's done with Centurion, which had the North Goonyella fire back in 2018, I think they spent just a little bit under $500 million to restart that. Now they have a contingency payment of $450 million on top of that. So Grosvenor is $1 billion project now for 3-4 million tons of met coal, which I'm not sure how that's necessarily going to work out all the time. So at least for the analysis that I did, and I didn't look to see if there was ever an expiration date on that. There probably isn't. I don't think. I didn't see one. But mostly for my purposes, it was about, well, let's just digest the rest of the deal and see what that sort of looks like. And when you just plug in the numbers that Peabody gives you, if I run a 10-year DCF on that, I get about 2.5 billion, which is kind of what they're paying in cash and deferred payments, right? It's like $600 or $700 million deferred, and then 1.7 upfront. So without doing any math, without doing anything fancy, I get to the same number they get. I think the question remains sort of what the question was for Whitehaven when they bought Blackwater and Daunia. It's, can Peabody absorb the assets efficiently and quickly, and then can they operate them with success? If the answer to both of those questions is yes, and I think you should issue some allow for some growing pains, then on the merits, it's probably a pretty good deal for them. My personal opinion on the contingent payments that are linked to price, I do think we have 2 or 3 years here where the market's going to be pretty reasonably balanced, and the decline of Chinese downstream demand for steel is kind of what's going to wind up setting that price. And right now, it's hard to see past the fog of surplus, but it looks like we have at least another, call it 9 to 12 months, maybe longer, before we see the end of that. So I think year one, at least on an average basis, is probably out of the question to hit. The targets are 240 per ton in year one, 235 per ton in year two, 240 again in year three, 246, and then 252. By the time we get out to the end of the decade, I think we'll probably see those numbers again. But it's going to be, I think, pretty touch and go here over the short term. I don't know if you guys have an opinion on that either, by the way.
I'll let Koala answer that.
At 225 consensus hard coking coal prices, 65 per short ton EBITDA. Matt and I have gone through the transcript, and it appears that Peabody guided to about 22 per short ton of CapEx. So let's just call it $40 pre-tax free cash flow per short ton. Even though Australia loves taxing even more than the United States, let's call it a 25% tax rate. That means 40 pre-tax per short ton free cash flow is more like 30 after tax. 11.3 million short tons. That's 340 million after tax free cash flow. So, and they included this 100 million of synergies in this guidance. 100 million at 25% taxes is 75 million of after tax free cash flow. So without the synergies, 340 would be 265. Peabody paid 2.32 billion. So without the synergies, they paid 11.4% free cash flow yield. Including the synergies, they paid 14.65%. What does that mean? That means Peabody paid the value of all the synergies to Anglo-American on this deal, which means, and what's the delta there? Very roughly, it's about $500 million. If you just said, you should just bid 15% free cash flow yield at consensus with no value to the synergies because those are yours to capture. So Anglo, hats off to them. And you can see in the reaction of the stock's gone, of Peabody's gone from 28 to 24, 125 million basic, call it 140 with the convert. You've kind of seen 500 plus a little bit of a WTF premium and fear of execution come off the stock. Kind of reflects the reaction. But I think what also needs to be considered here is $2 billion of debt. Let's be generous and say 8% interest rate. That's 160 million of interest, 120 after tax, 340 of free cash flow, just became 220. Then you have the 156 million of deferred payments every year. So what are you looking at? You're looking at 60 million of incremental free cash flow at 225 benchmark met coal in the first 4 years of this deal, or less than 50 cents a share accretion to Peabody. And to the upside between the Queensland royalties and the contingent price payments, there's not that much upside. But if, God forbid, coke and coal stays at 200, doesn't go to 225, this looks like a break-even free cash flow accretion in the first 4 years. Dare I say even maybe negative if the mines don't deliver according to Peabody's plan. So what are we looking at here? It looks like Peabody overpaid. The markets punished them for it. It's unclear why they had to bid what they did. And a big debate we're also having is this deal better than Whitehaven? Well, Whitehaven, you could do the very simple math that they had over $1 billion US of cash burning a hole in their pocket. There was no way they could buy back $1 billion of stock without the share price reflexively bidding higher. And you could very clearly see that within 3 years, they were going to effectively double the earnings power of the business without equity dilution, because they clearly signaled that they were going to explore a sell down of two strategics. Peabody has not taken equity or a convertible off the table. The messaging has been weak. The slides were not nearly as clear and concise as Whitehaven's. And I think one of the biggest interesting takeaways here is that it seems like every passing metallurgical coal M&A deal is better for the seller than the last deal, which tells you how we're past the peak of this ESG madness, and people are coming to realize the value of investing in met coal. Because my Lord, I mean, without the synergies, less than 12% free cash flow yield on the valuation. I mean, I've been having some fun joking about Warrior and the proposition there, but it makes what they've done with Blue Creek, which is $1 billion to get 4.8 million short tons. And if they run that long wall like they really could, because it's not a skip shaft operation, it's a conveyor and a decline. What if that 4.8 is actually 6 once optimized? I mean, it makes Blue Creek look brilliant and genius. So Peabody overpaid. They've been punished for it. We look out 5 years, provided they execute, it'll look fine. But it seems like with every passing deal, it's better and better to be selling a coke and coal mine.
JD used the word to me like earlier when I was talking with him, kneecapped, and I sort of thought like it's like it sucked the wind out of Peabody a bit for the next 5 years, because the upside, like you want a coal stock in a lot of ways, you want to be exposed to the bull thesis, but the combination of the Queensland royalties and the price-linked contingent payments, like you talk about, kind of just zap out the excitement you get about a bullish met coal scenario.
Well, why don't we ask the obvious question, which is, what Matt, please chime in here, but what is AMR? AMR is about 16 million short tons of coke and coal. And because of the Queensland royalties, if you look at 225 or 250, the actual EBITDA per ton, and even with the CapEx, call it the pre-tax free cash flow per ton of the AMR portfolio, is the same as the Anglo portfolio. And so great, if coke and coal goes to 150, 160, the royalties fall away for the Anglo portfolio. But if you're buying these assets, you're really playing for coke and coal's not 225, it's 250, it's 300. So a really honest God question here is, why didn't Peabody just go bid for AMR with stock and say, well, if coke and coal goes down, we have a pristine balance sheet, we'll ride it out? There's a lot of really interesting points to consider here, because at least in the US or in Canada, if we get a spike to 300 or 400, you actually get to keep the effing money. And you don't go into coal and get eggs and tomatoes thrown at you and be told that you're destroying the earth and that you're evil at Thanksgiving dinner without getting the effing money.
I think you really hit on something there, at least for me. So I put together like a file just for comparison's sake. our friend Respeculator had tweeted out a sort of comparison between, SMR as it is with, 13 million tons of production and the Anglo assets. And he had the relativity up there, the CapEx of tons. And when you link the royalties to the price, like what you can see is that, in Australia, you get punished for those high prices when you're capturing the entirety of the relativity, assuming, of course, that the Australian dollar exchange rate remains in the mid 0.6s, and the United States doesn't torch our USD over the next 4 years by conducting a trade war. So there's risk to that sort of assessment, right? But when you start taking the price of coking coal up, it becomes clear that anybody who has a relative discount or alternately doesn't have the same type of price related costs that Australia has is at a significant advantage. And so when you take the price up to from 225 to 250 for Peabody's assets, just on a cash flow basis, not considering contingent payments or anything like that, for every $25 in incremental price improvement, you get about $100 million more in free cash flow. That's with the royalty in place and all that sort of stuff. But once that 40% royalty kicks in at $240 or wherever it is, I can't remember offhand where the Queensland government has set it, and you start ratcheting up to like 300 million or $300 a ton or $400 a ton. If you compare AMR and HCC side by side, HCC Warrior with especially a fully ramped up Blue Creek, I mean, it just smokes it because the variable costs stop. There's AMR it's hard for them to compete at really lower price because the larger transportation cost from Central Appalachia to the port eats away a lot of the profit for those export tons, whereas Warrior, located in Alabama, has a much lower transportation cost and is pretty well fixed at like $30. So it goes from maybe 25 to 30. So it just stays in this range. When prices go way up, the transport to the ports in the U.S. is capped at right around $60 a ton. It didn't really go up much beyond that during 2021 or 22 when prices got up to $600. So once the transport gets capped in there, port costs really don't change. All of a sudden, the U.S. assets start to cash flow way more than their Australian counterparts. And even if you look at a company like Stanmore, that relativity, that 77% relativity or what it is a benefit to them because they just have to pay less to the government in tax. So that to me is kind of the dynamic of this coking coal market over the next few years from an investor standpoint. It's like when prices are really low, you have to find the companies that can go and compete on a cost basis and get the best margin. But when the price is rising, you have to find the people who can maximize their margin at a faster rate of acceleration than everybody else. And that's really the difference between the two regimes. Peabody's rationale for buying these assets is that it's close to where demand increases are going to be, and that's right. They're not going to have a problem with branding these or selling these, whereas in lean times the U.S. does have some comparative problems. So this is a very long-term sort of vision for Peabody as a company, which comports with the fact that they're 150 plus years old. They want to be mining coal in 2134 or 2124 or whatever. So the idea that they're going to be outlast their management is of importance to them. On the investor side, what's happened over the last few months is they've come out and said that shareholder returns are a priority, and then turned around and done a deal for a lot of people, which we've seen result in the stock price here over the last couple of days, that does not work with what they were told. And, they were told one thing, and Peabody went out and did another thing, and that's not cool if you're measuring your success in terms of profit and loss over weeks and months and quarters.
It's also really rich to say. It's also really rich to a month and a half ago do a full webinar saying how Centurion is the greatest coking coal project globally, and then 6 weeks later, come out and say we're going to lever up to buy assets that, look, I mean, Grosvenor's on fire. Like if you're a Peabody shareholder, and hence the joking tweet last Thursday night, I mean, this is a here we go again. Like, okay, yeah, maybe Peabody knows how to fix it in due time, but if you're a Peabody shareholder now, you go, okay, we have to work through this contingent, we have to deliver on this plan, and then we need Centurion to come in because there's really no free cash flow unless Met spikes, but then you really don't get a huge free cash flow increase because of the royalties plus the contingent. So you need Centurion to deliver. So then the rest of the business can delever the balance sheet, because then you have a huge speculation on how much debt can a coal company actually hold. If we talked about this 4 years ago, no debt was acceptable. Now maybe some debt is acceptable, but every management team and board remembers the world where you couldn't refinance maturing debt. So we are a long way away from people feeling comfortable saying, oh, I can have 1 turn of EBITDA on my business perpetually. But now Centurion's got to come on. You got to work through these 4 years executing this brilliantly. Then you got Grosvenor. In the meantime, I mean, isn't Peabody still kind of a thermal coal company with a question of what's going on in Wyoming and Illinois Basin? I mean, if I had to speculate, I think the grander plan here has to be that MacArthur is going to come back because Peabody in the future will be an Australian company and a US company. And we're thinking about 2030s M&A then, but this Australian portfolio, once you digest the next 4 years, is an interesting portfolio to pair with someone else. It's just it's getting it's kind of forsaking the USA, quite ironically. But you have an NYSE listing, and the Americans love coal more than anywhere else. Glencore was going to be on the New York Stock Exchange, so maybe there is some 4-dimensional chess being played, but you still got to deliver on these assets in the next 4 or 5 years. And the unfortunately, there just isn't, I don't think, the license to do that quite yet. So they gotta deliver perfectly.
Yeah, and to your point, my marsupial friend from earlier, you mentioned that the sellers have done really well in this environment. If what you're proposing does actually come to fruition, it's going to be really fun to sell or spin off some assets in that time frame when people have realized that you can't project manage your way to green steel in a decade. Like that idea in and of itself is a pipe dream even to this liberal here. It's not possible in the time frame that people want to achieve it. And as a result of that, and because there's no more premium low vol really coming to market, like this is the part of global supply that is going to be under a lot of pressure over this time. That's the fundamental thesis for why met coal is going to be much higher for longer. We've had a really terrible year, and the lowest we could manage to get was like 179, which is almost $30 higher than what the long-term price was in the before times pre-COVID. And that's the thing that sort of, when I think about it, makes me incredibly optimistic for the next decade. Doesn't do much for short-term enthusiasm for BTU shares, probably, but stepping into their shoes and looking out over the course of a decade, I get it, and it does make some sense, and they can capitalize on it. And the rest of the business,
they overpaid. I mean, we've joked about this, but I mean, to outbid Gary Nagel and Matt Lattimore for a Queensland coking coal asset, the moment you find out you win, you got to be sitting there going, it's the Arrested Development meme. I've made a huge mistake. But you bring up a good point about, I mean, BHP has this thesis that the quality spreads are going to continue to blow out, and the premium hard coking coals are only going to trade at a bigger and bigger premium to the other coking coals. Well, where do you go get that stuff? I mean, in the Queensland royalty regime, no one's really inclined to build a greenfield in Queensland. I mean, frankly, I probably would say 20, $30 of the price is just the fact that that royalty regime exists, because no one's willing to go play and be an entrepreneur in Queensland right now. You're just not going to get paid that 1 or 2 boom year every decade that keeps you alive and actually makes this fun and worthwhile. You don't even get the windfall. So where do you go? I mean, Blue Creek is a really good high vol A asset, but it's not the low vol of 7, because that's just how the basin works. As you move across the river, the vol goes up. So where in the West actually is, you'd know West Virginia better than me, Matt, but there isn't really like a sweet low vol, premium low vol seam just waiting to be hit in West Virginia. So where is it?
Yeah.
It's probably, if Gary is so inclined and gracious enough to debottleneck Elk Valley Resources, and does he want to go talk to the Canadian government about buying the Dominion coal blocks, particularly parcel 73. But other than that, I just don't know where you go find 10, 12 million tons of Saraji, Moranbah, Peak Downs, quality greenfield, incremental capacity, and these things are depleting for all the talk. And we always get these lists of the copper pipeline and big copper projects of 100 KT, 200 KT for 20 years. I mean, go do the same analysis for coke and coal.
Maybe
It's an even shorter list.
Maybe the Canadians will get religion, mate, and Gina will have her way with Grassy Valley. 72% of the residents of Crow's Nest voted in favour of the development of that project. I think it was overnight. I saw that news.
72%.
Yeah,
That's great. That's
Koala,
Koala,
you made a comment just on the debt levels within Glencore a little while ago, sort of comparing it back to the trough EBITDA, I think 2016, roughly 8 billion.
Mm-hmm.
I've got in my sort of mind. Mm-hmm. How receptive do you kind of think they'll be to lifting that debt cap they've got, net debt cap?
I mean, I think in a totally sadistic, arrogant way, showing discipline and driving all of us insane further reinforces the point that we've demanded capital discipline from these companies. And who are they to deny us what we want and therefore tighten up the medium-term supply-demand balances? What do I think you probably get? Let's see, when Viterra closes, that should bring in some cash and some Bunge shares, which should be, I don't know, I think eventually you could probably consider that effectively cash. I don't know, does 10 become, you throw in the Bunge shares and the Viterra cash, maybe it's 10 is unofficially 12 or 13, but like, it's a function of, I think, having discipline and having credibility as a management team. You almost have the case, why would I extend myself here? Why would I give you what you want when you won't even give me a valuation on my own stock that recognizes that you see how robust my business is? So if I was Gary, I'd be wondering, why do I loosen up at all? Because actually, at the end of the day, by not loosening up, you probably end up making more money in the long run.
I want to.
I'm not expecting any crazy in February. I mean, you'll probably get, I'm guessing, like thumb in the air, 3 to 5 billion of buyback plus dividends, all in combined. And then you'll get a top up in August. And it's just going to be, it's almost going to be like Chinese water torture, just slowly letting slowly the buybacks erode away at the share count. What deals are actually there to do for Glencore right now? Because we've heard Gary say, I'm not going to do copper until the market's crying out for the tons. What I hear when he says that is, until I get an IRR on that is equal to buying back my stock using spot copper, I'm not going to use copper prices 20 to 30% above spot to justify the investment. So it's got to compete with buying back, or quite frankly, it's got to compete with the next coal deal. if there ever is one, he's showing restraint, which is good.
Breaking news, nothing to do with coal. How fucking good is dissect?
Wow.
Wow. Mate, in the air, on the ground, geophys, magnetics, bloody gravity, bloody seismic surveys. Nathan Dash.
It is a specialised skill required to execute and get the data that is so important to conduct proper geophysics, geology, everything, mate. And
yeah, look, coal's good. I like coal, but I'm not going to try and weave this into coal because dissect are just awesome in their own right. Not even coal related. They could probably bloody do some fizz to find your coal. They'll find you any bloody metal underground. It's the first step of exploration and mining is getting dissect on the ground or up in the air, doing geophys work for you. They're the only geophys company I know because I only need to know dissect. Easy as that.
Complete no-brainer.
How are you going to find your discovery without having all of the data? And where do you get your
How
data?
are you going to use the word discovery in an announcement without dissect? Call Nathan Dash. His number's in the show notes. Let's get back to coal.
I want to get your both Matt and Koala, your opinion on the parties that were in the process that ultimately didn't come away with the chockies. Maybe for better or for worse. And I think we've got to do a ding, ding, ding. Matty owns Anglo.
Oh yeah, fuck! I own Anglo.
I
Probably should have said that.
I own Yancoal, so yeah. So like on well, we'll start with the seller actually. On Anglo's front, above expectations, a point for Duncan, and buys himself some time. Would you agree with that?
Yeah, I think so. The next phases of Anglo's divestment are a lot harder than this one. Let's be fair. There were people who came out of the woodwork and got very far into the process that I was surprised at. I was surprised, Yancoal was. I thought Gary would come in and just take this down, but the willingness of Peabody to pay up and do the contingency deal, and they'll probably sell down a portion of it, a la Whitehaven, at some point in time. I don't know if they're going to get the same premium that they paid in the short term, but even $1 billion helps close this thing, right? I was surprised that Stanmore got as far as they did, but they brought in this consortium with Gear and Matt Lattimore, which all of a sudden sort of makes it intriguing, right? Just the fact that they beat out Glencore for the assets, I think to me it's kind of indicative that this, out of all the things that Anglo has to sell, this was the easiest package. There were people who were willing to come out. They recognized the value of premium low volatile met coal over the next, not 2 cycles, but probably 4 to 8 at the very least. And we're willing to pay up for it. When you think about nickel, nickel's going to be tough. Indonesia makes nickel, pretty difficult. Platinum in South Africa defines challenges, I think, for a lot of people. Mining conditions and those sorts of things. And then you have De Beers. Like, can De Beers stand on its own, or I don't know the answer to that because I'm the world's worst diamond analyst, but there have been a couple of research notes that have come out that sort of highlighted those. Nickel's not undoable, I guess, but it's not the best time, and it's not the best package of assets. It's really, copper is what people are horny for, and that's the one that's going to make the splashy headlines. That's what BHP wants at the end of the day. It's what Mike Henry wanted to come in and snatch out from under them. So. I don't know, Koala, what do you think the process is going to look like for Anglo as we go from here on into the next stages?
Well, let's just look at the half-year result numbers presentation. 11.1 billion of net debt, 5 billion of proceeds between the deferred, the upfront from Peabody, the Booma money, and so look, 11 just became 6. The nickel, these are not massive nickel sulfide, copper, PGM, polymetallic operations. It's 1% of EBITDA, mostly in Brazil. Give it away. The PGM business, they just did a 500 million block like yesterday or 2 days ago. So 6 billion is now 5.5. They also did another block like 3 or 4 months ago. I think that was after the That was after the half year. So I think it's now 5 net debt pro forma. Can Anglo Platinum, which runs, as I recall, net cash, can it incur net debt in some form? Maybe, but 5 billion. And so PGMs are gone. Then you look at De Beers. I mean, is there a reason De Beers, which is a diamond operation, why couldn't that be a Tiffany's-esque brand, or have some very interested people that see the pathway to, that's not a mining operation, that's a luxury operation. If De Beers if someone's willing to invest in stores and so forth, but you're telling me you're not going to get $1 billion or $2 billion for De Beers? Yeah, you probably are. I mean, this all comes together and everything closes. Anglo's down to 3 billion net debt. They're kind of home free. And Duncan then gets to play this little game of proving out that a re-rate's there, or that the premium iron and the copper can continue on. But I think then the question is just what happens to the stock, and do they continue to execute? I mean, I think everyone, I talked about this at the time of the BHP bid in the first place, I think everyone's chasing these like Freeport multiples, and they just don't recognize how much S&P inclusion, passive flows, and the ability with massive trading liquidity to appeal to a generalist who's just trying to do a rate of change trade on a commodity price, renting a stock, can drive some of these things. So look, I think Duncan's a winner here. I mean, 5 billion in proceeds with Grosvenor, one of the crown jewels, on fire, is bravo. Absolutely brilliant. So Duncan goes from someone who was on the ropes to someone who's turned out to have one of the strongest years among mining CEOs with this outcome.
Yancoal, when divvy.
When Kestrel.
When Ferb.
Yeah. When Ferb is probably the right answer to when Kestrel. Yeah.
When BMA.
Interesting look there, Matt.
Yeah, it's I don't think so, but it maybe do one of those. Yeah, but maybe we'll see. It's when Ferb and I think when Kestrel are probably the next two questions, right? I think Kestrel's going to be up for sale. Koala and I talked about this for years at this point. You know, when is that going to change hands, and you know, what's the price going to be when that happens? You know, I think Yancoal would be a very good destination for that asset in particular. But you know, they got the balance sheet to keep it up. You know, the quality. Honestly, like the quality of Kestrel competes with a lot of U.S. mines as well into Asia Pacific. That's a big thorn, I think, in a lot of U.S. folks' side. So like, you know, I look at it as kind of an essential operation for, you know, the next 10 years in the market. I mean, there's just not a lot of really good, you know, quality, you know, high vol in that part of the world. And, you know, Kestrel's in that kind of tweener vol range between, you know, mid and high. There's a whole lot of mid vol in Australia, and the Indians mostly have dibs on that. That's really integral to their sort of coal blends. But you know, right now, you know, the only high vol game in the world is you know, the combination of AMR and Blue Creek, and you know, to a lesser extent Lear, when Lear can produce. We'll see if Consol can you know, right that production ship there. But that's everything else is just kind of like, you know, higher quality thermal coal when you really talk about the high vol B assets and the semi-soft and that sort of stuff. Like there's a shortage of, you know, really decent CSR material where you can put into a blast furnace or into a coke oven and hit that, like, you know, 26 or 27 vol blend that Japan likes to hit, or the 25 or 26 vol blend that India likes to hit. You need those components in order to make good quality coke and make good quality steel. So that's, to me, that's an important sort of dynamic there.
I think Matt hits on a couple things here, which is had a meeting with a met coal marketing guy last week who said, like, we talk about the different vol numbers, and to a generalist, I think, frankly, even to me, it all sounds like total like gibberish, chemistry gobbledygook. But the reality is, putting these coke blends together and making steel, these coals, we talk about them as commodities, but the truth is they're actually specialty chemicals because these furnaces and these blends are so critical. Now, we'll never get a specialty chems multiple on these stocks, because if we did, you'd never see me or Matt ever again. But I think there's something to be said there. But also on Yancoal, I think the biggest debate is, let's pretend they can't buy anything. It's dividends, and it's Gary Nagle, I believe, when he was last in Australia, was talking about why will New South Wales, why are they dragging their feet on recognizing that coal has a much longer duration left, that as the rest of the world's figured out. So why isn't Hunter Valley getting mining license extensions? If I'm Yancoal, that's probably the most topical question right now, as I think about the portfolio as a non-shareholder, just outside looking in. And then it's dividends. I mean, but they've executed well. The M&A they have done has gone well. I mean, it's a shame they haven't been able to do M&A because of FERB, but what's wrong with a business that's just printing cash? And I mean, unless we wake up and God forbid they've decided we're going to build solar farms across the outback. I mean, yeah,
Bring on Yan
shame they missed, but it is what it is. And Stanmore, you just sit back. You've done some amazing deals. You have great partners. You print cash. You probably take a look at Kestrel, and you sit back and you just count your money.
They actually acquired the Greenfields project recently, Koala, in Eagle Downs, which will be interesting to see if they develop.
Who does that come from? That was
Came
South
from
32?
South 32. Yeah,
That's 32.
South 32, yeah.
Yeah.
I mean, I did some work on Eagle Downs earlier in the year. I've done it twice now. I think that's a 2030. It's probably going to wind up being like a 2035 part of the cycle for that. Yeah, I'd be surprised if it came out sooner, but it's, to me, not a priority at the moment. That's like a call option on that particular quality. The other thing I think that's sort of interesting to think about, which in the market really nobody's talking about, is that because the price of met coal, and the Peabody Anglo deal sort of confirms that everybody in the industry thinks prices are going to be elevated, start with a 2 on average, give or take a little bit for a long period of time, and are going to rise over time because there's no more tons coming on. When you look at it from the other perspective, let's go from the steel perspective. You're like, Jesus, my costs are really high, and my downstream demand is India. Like, India is really the only country that's growing domestic steel demand over the next 20 years. China's going to be in decline, and the global steel industry is basically like, will India's growth offset China's decline? We don't quite know yet. All of that is going to depend on China policy, which I have no track record of being able to predict. I'm a consumer of that information, not a generator of it, right? So, if you're looking at your downstream demand, and downstream demand doesn't look maybe as robust as it once does, and maybe this starts to drag on, you're looking at your coking coal costs going, geez, how am I going to mitigate this over time? And the way that Europe did it when labor costs rose is they started injecting more PCI. And there's nobody talking about PCI right now, low vol PCI in particular, because the lower the vol, the higher the fixed carbon. And it's really what you're injecting, heat content and carbon to replace your coke. Nobody's really talking about that either. And Russia being in the industry being in such a foible that it is, you could make a case that quality low vol PCI is probably going to be constrained when we get out into that era as well, because the injection rates at Indian coke at Indian blast furnaces are going to start to creep up toward the injection rates that we've seen in Europe, here over the past 10 years. I haven't seen anybody really discussing that at all. That implies that relativities for low vol PCI producers are going to improve over time, which, by the way, includes Peabody. So there's there's a lot more, I think, going on in the global steel market than necessarily meets the eye, and it's a story that's in flux. Like, I think everybody knows the hard coking coal story, but depending on, sort of like geopolitical changes or supply chain rearrangements, the musical chairs of geopolitics influencing who can trade with whom, the blends of coke ovens and the cost mitigation strategies of blast furnace steel producers also play into how this market develops over time. And that is a really complicated market with a whole lot of moving parts, with a whole lot of different people who have vested interests in the industry. And even me, who's covered this market now for pushing 20 years, I don't necessarily know how that's going to play out, but it looks like it's going to be an issue 10 years from now.
It's probably the perfect spot for me to put. I mean, you spoke of a tweet from Respeculator. I saw him tweet out this headline from Reuters. It said, India's JSW Steel sale in talks with Mongolia for coking coal shipments, sources say. And his tweet was, "Rest in peace, Queensland, coking coal." Is it as dire as that?
No, I don't think so. So Mongolia can produce as much semi-soft as they can, and India has been pretty clear about their blending strategy thus far, right? They want as much high quality, high strength coking coal as they can find reliably and over time, up to as much as like 30-40% of the blend, and the rest of that blend they're going to pack with absolute, dog crap. So they're going to use domestic coals, which don't have a lot of stability. They're going to stamp charge coke, which you still need stability for, but it really loosens the type of high vol material, which is really what that is. You're still hitting your vol target, but you're filling that upper portion with crap that doesn't really help the inherent stability. You're going to make up for that with stamp charging. So like that's true as well. And there are a lot of coals globally that can sort of fit that bill. There are a lot of coals in New South Wales that can sell into either thermal coal markets or semi-soft markets, depending on what the demand looks like on the thermal side versus met. We've seen that play out in the U.S. with the development of the high vol B market, which is really thermal coal with decent coking characteristics, but not traditionally good enough to be included in traditional coke blends. So those markets have been created for a reason. The nomenclature in the Asia Pacific region in Australia is a lot different from the nomenclature that we have, but it's all kind of the different sides of the same coin. Give me as much quality stuff as I can afford, and then fill the rest with as much crap as we can put in it that's super cheap. And that's how you address the future. And that's why I brought up PCI, because that's another way you just reduce the overall amount of coke that you need, so you don't have to rely on as much. Like, all these things are going to happen at the same time. It's not one variable. It's a multivariable calculation with a geopolitical overlay. Like, it's really hard. It was really hard 10 years ago to figure this out. It's even harder now. In when we were laying, the energy transition, the green steel transition on top of that, it just added another layer of complexity. So these are all human decisions that we'll have to see over time how it's going to play out. I still feel confident in saying that the low vol side of that equation, maybe not mid vol, maybe mid vol suffers, maybe second tier hard coking coal suffers over time. Maybe those relativities don't do well, but I think it's a given at this point that you do need those quality coals for structure. Period. End quote.
I will just say that global supply demand all interplays, where if a ton comes into from Mongolia goes into China, that's one less ton they either have to produce domestically or import from the seaborne market. But to a headline that says JSW is exploring coking coal from Mongolia, the Koala has one question: how many tons of coking coal have come out of Mongolia and been consumed in a country that is not China or Russia? Honest to God question. I don't know the answer, but I have a suspicion what the answer is. But JSW has been involved in so many of these processes, and the fact they haven't been able to be a dance partner, even on the minority side, has been very surprising. And if you told me, hey, the Indians are going hard in Mozambique, where I believe they both bought the Rio Riversdale assets and the Molazzi Vale assets in the mid 2010s. I would imagine the Indians are going to go very aggressive there, trying to expand that and optimize that. But yeah, this is a fun little puzzle to solve. But I think everyone's willing to comfortably underwrite a long-term price that starts with a 2.
Yeah, which that makes me pretty excited. I gotta say, the even after the boom of the last couple of years, like we're at this point in the cycle where these outlandish things that Koala, you and I were saying 3 years ago in 2021 about how the long-term price of met coal starts with a 2 are now manifest. Like we're doing deals on these levels. You're seeing deals that can imply, the ability to hit 300 on a regular basis. And I think that's, at least the snapshot of the future that we have now, that's real, and that's what, Peabody saw when they went to go get these assets. They don't control when these assets come up for sale. They can only control their actions when they are for sale. And if they,
Yeah, I mean, what's left? BMA. What's left?
Yeah,
what's left of it? BMA is the only thing left, and then BMA and Warrior are the only things left.
In the U.S., you have Metinvest, a Ukrainian-owned company that has solid.
But how many tons, Matt? How many tons, Matt? And yeah, so where's the move? Where's the billy? Where's the yard? The 2-yard deal? It's BMA, it's Warrior, or if we decide that we're going to build 1 million more blast furnaces in Pennsylvania and Ohio to cement that Midwestern voting block, then maybe AMR becomes much more strategic. But there just isn't any more deals out there like this. Like we've kind of had our M&A cycle come through for coke and coal. Maybe there's one more left. We'll see. I mean, shareholder rights plan falls away and poison pill falls away May 2026 for Warrior. Not that the Koala has that date circled at all. But yeah, I mean, at the end of the day, Peabody paid up. I think they've been punished accordingly. The 500-600 million of overpay has been taken off the share price. And I think now it's like, okay, now you guys have to execute. If you don't execute, you're now levered and we have very serious problems. But they made their bet. They
did. I was going to say the base level of the business that they have. So the PRB assets, the US assets, the Australian assets, they already have ex-Anglo is somewhere between, free cash flow, not EBITDA for 2025 and 26 is something like 280-300 million for 25, and then when Centurion fully comes online, call it 500 to 550 million dollars in 2026 at their current sort of prices. At spot, maybe that number is more like 200 and 400, but still, it's not zero. They are going to have a little bit of leeway to work with, should they have a little bit of growing pains here the next few years. But from a just a share price perspective, in a free cash flow perspective, like the next 3, you can sort of pretend like this doesn't exist until they've proven that they've proven that they can digest and operate the assets and generate, do the good old fashioned blocking and tackling, generating free cash flow that every good miner tries to do.
Well, I mean, anyone who complained that Whitehaven shut up the buyback to buy Blackwater and Daunia, or to go back to 2021, and a former colleague said to me, Koala, Warrior is so stupid to build Blue Creek instead of buying back stock that I want to short Warrior against all my other coke and coal longs because this management team is so stupid for trying to bring supply into this market. Blue Creek is 4 years away. This is so stupid, Koala. I just need you to understand, I do not want you to say that we should just own Warrior because in 2 years it's going to look great. Shocker of shockers, it looks fabulous. That guy's also been to the mine now, and I've heard him say that he thinks it's brilliant. Shows you how short-sighted the market is. But in a world where Everyone was livid about Blue Creek because it was a pause on capital returns, even though it was funded from cash on balance sheet and free cash flow generation. A world where people were mad at Whitehaven for showing that you could grow through the numerator, not growing the numerator, and not just shrinking the denominator. Peabody has now turned around and said, we're growing the numerator, we're levering up materially, and it's going to be 4 to 5 years, not 3 years, to the promised land. So I was just thinking about, as you were talking, Matt, we've gone from a world where people are angry about, well, we're pretty conservative and pretty reasonable decisions that within a couple of years look genius. And the duration of these bets are only getting longer as the valuations on these deals have gotten richer and richer. This is where it's going. I mean, you have to kind of now say Peabody's a call on perfect execution for the next 4 years, starting in mid 2025, and then 2030 is coking coal. Now, in a private world, I think that's a very interesting deal. We can quibble on the entry price, but I think if you believe that green steel is not showing up until the 2040s, 2050s, it's going to turn out to age pretty nicely. But you can't screw up. And if you do screw up, you got to pray to God that 300 to 500 million free cash flow is enough to fund a QB2-esque blowout or delay or disaster. If God forbid you put a foot wrong. But yeah,
that's right. There, as Andy Edson said to me back in May, there are no upside surprises in mining.
I think that's a good place to leave it. It feels like the first time in maybe longer than a decade that it's a good time to run a sale process on a coal mine.
I can't believe it myself. I mean, out of all the things that we've talked about with regard to the deal, that the market has talked about, that people have complained about on Twitter, that's the thing that I keep coming back to, is like, regardless of what people really think about the industry, like we need it. And you know, the attitude of management over the course of my career has really shifted from, you know, this sort of almost antagonistic, you know, why would you, you know, want us to go away, you know, indignant sort of attitude toward, you know what, we're just going to go mine coal, and we're going to help. We're here to help you. We know you don't like us, but you still need us, and that's cool. But we're just going to go do our thing, and that is the best possible way, at least in my opinion, to actually go and, you know, change hearts and minds about the industry. Is just to help. You know, as in the U.S., you know, to quote John Kennedy, like, you know, that's not what you can. That's not what your country can do for you. Ask what you can do for your country. I mean, you know, just taking that attitude, you know, and sticking to it from a leadership perspective, which is a real transition that we've seen, to me is really heartening, and tells you that there's a lot of quality people who are going to work in this little industry that I love so much.
I would just close with saying that for the first time in a decade plus, if BHP said we are going to sell BMA for cash, which based on EVR would be somewhere between $8 and $12 billion, and we're going to use that cash to fund the $12 to $14 billion of capital we have to put into Escondida and Chile just for our South American copper business to hold serve. For the first time in a decade, I think their shareholders would say, no way in hell, keep the coal cash cow. If we'd had that conversation 5 years ago, they would have said, yes, great idea, BHP. Well done. Get rid of bad coal. I think today they would say, now why the hell would you do that? And that's the sentiment shift.
That's right. And that's the sort of thing that makes me want to get one of these hats and just put it on like this and kind of say, you know what? It's a perfectly fine time to wear. This is my clean coal hat, by the way. It's all white and pristine. You know, to put one of these on as a card-carrying liberal and sort of say to the world, like, hey, you know, like I said, we're just here to help, and we're going to carry that attitude into the next decade, into the next 2 decades, and try and be you know, as active part of things as we can, you know, as an industry, across the world and shepherd goodwill everywhere that we can.
The only other person I've seen wear a hat like that, Matt, is Adam from CRE Insurance.
Is that right?
Shout out, Adam.
I wish I don't know why we didn't for your Zoom picture koala replace the K with a C. Just koala. Anyway, we could do that in the post. Would have been pertinent for this episode.
Maddie, I think this is a record for the least number of words you've said in a Money of Mine episode since the beginning of the podcast.
What's the point of me talking when I got you here, mate? So,
beautiful.
Right,
well, thanks so
boys.
much for joining us on Blackout Wednesday.
Well, I'm not really blacked out. I did bring a couple of bottles of things to polish off. I figured, with the Peabody coal assets, we'll get some old really high quality bottles to polish off. But we were talking so much I didn't even get to touch it. So no blackout for me. It doesn't look like it's going to be just a regular.
Thanks for making the time, guys.
And I'm on espresso.
Beautiful.
Cheers, guys. Pleasure as always.
Awesome. Happy Thanksgiving tomorrow.
Righto, there we go. Fucking, geez, when I know fuck all about something, I don't speak. But why I need to? What do you think, boys?
Mate, it's good getting those two guys on. I can just sort of sit back and coast and listen to a couple sort of smart brains break it down in a different style. So
JD and I probably did 3 hours research this morning. Completely unnecessary. We didn't need to talk.
I didn't need to do any of it.
I told you I was always efficient.
And we still learned plenty, but yeah, it was great.
It was interesting, the aspect of what deals are remaining, considering what has been done, like, Blackwater, Dornier, this one, all the other ones, but it doesn't look like there's many to go unless do you think BHP would divest BMA?
I heard Koala say that. I don't think so. Yeah, no. I don't think so. No.
Interesting. I didn't get the chance to sort of weave it in, but I just read right before in an article by The Australian that Yancoal had actually bid more than Peabody.
Yeah, I thought that was well known. Yeah.
Yeah, didn't get the chance to weave it in there, but it was kind of an interesting one to, form an opinion on Yancoal, their management, and how they might approach M&A if they get the opportunity to do any.
But didn't Hags originally say when that the most logical fit for all these Anglo assets was in the BMA portfolio, and obviously now it's not. That's not where it's going.
Yeah.
So does that then create something for Peabody to have that logical consolidation later on?
I think the deal that Koala was alluding to there for a future deal with Peabody was actually a merger with Whitehaven.
Yeah. And then they do it.
I don't think that BHP will part ways with what they've got there. I think they'll own that for a long time.
Yeah.
Couple of partners to thank, I reckon.
I was thinking these people that own these companies are going to own them for a long time too, because it's friggin' awesome. Mineral mining services, based on all the polo shirts everywhere, they're not going anywhere anytime soon. Grounded, Paul Natoli, he's not going anywhere. Lifelong. Sicily owns Grounded forever, effectively.
In perpetuity.
Mate, our great friends, CrossBoundary Energy, give Timmy Taylor a call, just to say good day, if anything. Sandvik Ground Support, CRE Insurance, K-Drill, dissect. Bloody good weekend, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.